So in 1953 in Shawnee, Oklahoma, there was a restaurant named Top Hat that was opened. The owner was Charlie Pepe, and he was a veteran who had just come home from war and just was looking for a way to provide for his family. His main goal was customer relations and providing the best food at a fair price for these people. So, one day, Troy Smith was passing through town. He was also another veteran who was just looking for a way to provide for his family. He had a conversation with Charlie Pepe and struck up a deal to open up another Top Hat in a neighboring town. So these two shook hands and agreed that they would work together to build this business. Unfortunately, the name Top Hat had already been patented for another project. So they changed their name from Top Hat to Sonic. And here we have the biggest drive-thru restaurant in our nation. We have over 36,000 restaurants from coast to coast. So, I picked Sonic because it's my favorite place to go just during happy hour or first thing in the morning when I just need to pick me up. So, I started looking at their financial information. And at first glance, it seems like they're doing really well. Their assets are really high, and they're expanding. They're constantly building. I feel like every Sonic I drive by has a crazy long line, or it's full. And after looking at all this, I realized that it's probably better to run some numbers. So their current liquidity is 2.425 with the fiscal year ending in 2017 in August. So I guess that's alright if you just look at it first glance. Kind of low. But then I looked at 2016. Their liquidity was 5.016. So that's like half of, in 2017 it was half of what it was in 2016. So I did a little bit of research wondering why it was so low and why there was such a dramatic change. And Sonic's explanation for this was that there was a change in the timing of payroll and other operational and tax transactions that were happening. And that these variables are what actually played a huge role. So I think they also spent a lot of time building and renovating some Sonics across the nation, which added on to their liabilities. And that after they invested so much money and time and property and land into these new restaurants, they weren't receiving the return on investment like they originally thought they would. So that's a pretty dramatic drop, and they noted that they were expecting this to rise again in 2018. Only time would properly tell you if that actually happened. Also, I looked at their solvency rate, which is total liabilities divided by total owner's equity. So this in 2016 was 1.13, and in 2017 it was 1.12. So that's 100th change. So while it didn't change much, it still is a very bleak outcome with this high debt to equity ratio. While this is actually good for the stockholders or the shareholders, this isn't actually super good for the people that are investing or any creditors that are looking through our company's financials. I think at this point they should be focused more on paying off the debt or investing a little bit wiser. I also looked into their working capital, which is just their current assets minus their current liabilities. And in 2016, they had 57,720,000. So that's pretty well. I mean, they're working pretty good with that amount. In 2017, it was 13,127,000. That's a huge drop, almost 40%. And the biggest contributor that I could find towards this was the fact that so many of Sonic's assets were going down while their liabilities were continuing to climb. So I also looked into their profitability and ran some numbers, which this was probably the best news from these numbers. So in 2016, they were making 10.6 cents for every dollar of their revenue in profits. So in 2017, they raised that from 10.6 cents for every dollar to 13 cents for every dollar in revenue. While it's not a super big climb, there's a little bit of wiggle room. And at the same time, they should probably still be watching where their money is going and how they could be better investing that. So finally, after looking at their labor cost, there was a 24.8% labor cost, but percent of the budget going towards labor, which is about average for what our industry runs. Labor is the most it is the biggest part of our budget, and we do have to plan that accordingly. So Sonic's budget was at 24.8% is pretty good. An average in our industry is anywhere from like 20 to 30% at the very highest. So they're running that fairly in the middle, which is good. But in 2017, they took that from 24.8% down to 22.5%, which is a pretty good drop, which means they either were spending more time training so that they had a lower turnover rate, or people weren't taking as long to do whatever it took to finish the job, which is good. And I feel like if they stayed on trend with this, they would be looking at a lot better deal. So, after looking at all this, I would probably say from a manager's standpoint, it's going really well. They are paying off their short-term obligations. They are, they're still investing. They're making their ends meet. Their profitability is coming up. Their assets are remaining the same while their liabilities climb, which is a little concerning. But their labor dollars are going down, which is the biggest part of our budget. So I feel like they're doing really well to keep that declining. But from an investor's perspective, I probably wouldn't invest in this company, at least not now. Maybe in a little bit I would, just giving them a chance to pay off some of their debt from their renovations, their new expansions. From a creditor's perspective, I probably wouldn't be extending any more credit to this company until they could pay off some of their debt. Because looking at it, they are running more on debt than they are what they are making. So, I learned a lot from this assignment. I would definitely say that there is a decline in some very crucial aspects, but at the same time, they are still doing well enough that they could increase it if they can keep their labor dollars down and their profitability on the climb, which are the two of the biggest contributors to a balance sheet. Just focusing on getting their assets to stay higher than their liabilities, which is one of my biggest things. It doesn't take much for their liabilities to overcome their assets. So they just need to watch that, because if their liabilities overcome the assets, they're not going to be able to keep doing it. They're going to go bankrupt. So that's just something that I feel like they should be watching, and they probably are, but You'll see. Only time will tell. Overall, this was a super fun assignment to consider.